Welcome to the Advisory Group's Mid-Year Economic Review. Let's first start with some introductions. My name is Manny, a Senior Wealth Advisor at the Advisory Group. With me is Brent Beverly, the President of the Advisory Group. Both of us are certified financial planner practitioners and wealth advisors at our Diamond Bar branch. At our firm, we partner with clients and believe that an educated client is our best client. So while we will always try our best to help you when it comes to your finances, we believe that knowledge is power. And one of our missions is to share with you any knowledge that can better help you make an informed decision. Now today's agenda is straightforward. First, we will review an equity market update. Then we will discuss some strategies and ideas that you can consider for the rest of the year and beyond. I find that it's always important to review that there are 5 key areas of financial planning. These are preservation planning, retirement planning, tax planning, estate planning, and finally investment planning. So even though today's presentation is primarily about equity markets, as a comprehensive wealth management firm, we try to always consider the impact of any recommendation we make on not just one, but all of these areas for our clients. Let's quickly recap 2023. It was a year that rewarded patient and long-term investors with some healthy equity returns. Following a rough year in 2022, as the chart here on your screen shows, as of 2023 and 2024, equity markets as measured by the S&P 500 index have made multiple new highs. Specifically focusing on 2024, year-to-date 2024 has reminded investors that equity markets do not move in a straight line and that volatility is part of the investment experience. So despite fluctuations, equity markets have powered through the year's first half. Equity markets have had some high points, all-time highs here in 2024. In January, the S&P 500 closed at new all-time highs 5 times. Again in February, it hit new all-time highs 7 times. Then in March, S&P 500 had 8 new all-time highs. Then after a pullback in March, again in May and June, investors saw brand new all-time highs. As of the end of the second quarter, the S&P 500 has had a healthy year-to-date return. The Dow Jones Industrial Average is one of the oldest U.S. indices and was first launched in 1896. It took almost a century for this gauge to reach 10,000, but subsequent milestones have been made quicker. 20,000 was reached in 2017, and it took less than 4 years to climb to 30,000. On May 15, 2024, this 128-year index of 30 companies passed the 40,000 mark for the first time. And as we have noted multiple times, owning equities can be good long-term investments. Some factors that influenced equity market performance in 2024 to date are a strong economy. So far, economic indicators have shared that the U.S. economy has been positive in 2024. No interest rate movements. The upward movement of interest rates from 2022 and 2023 has paused in 2024. Inflation. The inflation rate has decreased from 2023 and 2022, but it is still stubbornly higher than the Federal Reserve's 2% target rate. And so far for 2024, a high percentage of large corporations have exceeded analysts' earnings expectations. Looking at interest rates, this graph on your screen here shows that we are nowhere near the double-digit interest rates that the United States saw in the 1980s, but we are still experiencing the highest federal interest rates in more than 2 decades. For the first 4 of their 8 meetings scheduled in 2024, the Fed has kept the target rate range for interest rates the same. That marks 7 consecutive meetings with no changes. So since July of 2023, the target rate range has been 5.25% to 5.5%. Now there are 4 more scheduled Federal Reserve Committee meetings in 2024. Earlier in the year, it was anticipated that we could see 3 rate cuts in 2024. However, with a continued robust labor market and stubborn inflation rates, Federal Reserve Chair Jerome Powell has indicated that it could take longer than expected to begin cutting rates. This stagnation is a sign that Fed officials are concerned about providing the U.S. with their goal of a soft economic landing, and they indicated they need to see more movement in inflation and other key indicators before lowering rates. The Fed remains committed to achieving the 2% inflation rate goal and intends to hold steady or adjust rates accordingly should inflation pressures have a resurgence. Interest rates and inflation are integral to investors in their financial planning, so we will continue to keep a watchful eye on any movements and stay apprised of key economic indicators. If you look at the key economic indicators that the Fed uses to assess what direction to move interest rates, the economy is still strong. Unemployment rates are low and job growth is healthy, and labor costs continue to grow. Now, the Consumer Price Index is a key statistic used to measure U.S. inflation. It has slowed considerably since it surged to recent highs in 2022. As of June, year-over-year CPI, otherwise referred to as inflation, was measured at 3%. The Fed also closely tracks core CPI, which excludes food and energy, which was down to 3.3% in June. The core CPI helps give indications of where inflation could be heading. So while consumers have felt the impact of higher inflation and the trend has been a slow trickle down, inflation was higher than the Fed would like for the first half of this year. This dimmed the outlook of reducing interest rates so far this year, and most analysts are now looking to the fall for potential rate cuts. The cost of living and the cost of borrowing has been, to the consumer's dismay, high. According to Forbes, the average credit card interest rate was 27.65% in mid-May of this year. By comparison, in May of 2023, the average interest rate of all credit card accounts, according to WalletHub, was 20.68%. In May of 2022, it was even lower at 15.13%. Shelter and gasoline costs are still high, leaving consumers hoping for a reprieve soon. Now, you can tell why we recommend not carrying a balance on your credit cards if possible. Bond yields have risen during the first half of 2024. In early 2022, most treasuries yielded at near record lows. Now, investors can get some interest from bond yields. 2023 saw a few bank failures, which drove investors to treasuries in very large numbers. So far in 2024, treasury rates seem to have currently stabilized. As of June 28th, 5-year treasury notes yielded 4.33%. 10-year notes yielded 4.36%, 20-year notes yielded 4.61%, and 30-year notes reached 4.51%. Now, if you'd like to explore how bonds can fit into your retirement income strategy, please contact us so we can help you make a suitable decision for your portfolio. And please remember, while diversification in your portfolio can help you pursue your goals, it does not ensure a profit or a guarantee against loss. Now, we will continue to monitor how the Fed's movements and rising interest rates are affecting bond yields. Now, we feel that volatility is still prevalent and will be in the coming months. Investors need to be prepared with a well-diversified, long-term financial plan. Equities are long-term investments, and as this chart illustrates, even with downturns, long-term investors who have stayed in the market over 10, 20, 30, or 40 years were rewarded with considerable gains. Most economists predict that a market correction, defined as a decline of 10% or more, could happen. However, they predict even if there is a market correction, it will be a modest one. A recession is what occurs when an entire economy contracts for several months. Currently, we're not hearing a lot of discussion about any sort of major recession. So regardless of whether we see a market correction or a recession, this is a time for investors to stay vigilant and focus on their personal goals. Now, should we enter some challenging times, it is important for planning purposes to have some financial liquidity. This means that you should make sure you can meet your current and planned short-term and possibly even some mid-term financial obligations. So please let us know if you anticipate needing cash for a large obligation, such as funding a wedding, college education, a gift, or purchasing a new car. And for our next session, allow me to bring up Mr. Beverly. Brent?
Thank you, Manny. Now, as Manny noted, the U.S. economy has remained strong and seemingly unfazed by the continuing global unrest, including growing activity in the Middle East and elsewhere. So markets typically do not like uncertainty, and currently the U.S. is entering into a very dramatic election year that includes a heated race for the president's seat, for some contention in the Senate and the House of Representatives, state elections, etc. The results of this election could have an impact on policy and tax law. Therefore, we need to be watchful. We just had a couple of major surprises in the last couple of weeks with the assassination attempt on one of the major candidates and withdrawal from consideration of another major presidential candidate. And around the world, we continue to see wars and the possibility of more wars and disruptions. You've got Russia and Ukraine, you've got the Middle East, you've got South China Sea, you've got Taiwan, you've got Korea, you've got Central Africa. The world is just full of troubles. Uncertainty and unrest can be key factors for equity movements, and we'll continue to keep an eye on how they might affect equity markets in your situation. So as a recap of 2024 so far, we know that inflation is still stubborn and continues to be a possible cause for concern. The Fed is holding rates steady until they see more favorable indicators. Their goal is still a soft landing in the U.S. There are several key factors that could bring a possible market correction coming up. Volatility remains. Remember, a well-balanced portfolio should be designed to withstand and understand that volatility is always possible. Staying the course and maintaining the consistency of a well-devised, long-term, focused plan has historically served investors well. And last but certainly not least, we're here for you to discuss any concerns that you may have. Remember, once again, can't stress this enough, investing in equities should be viewed as a long-term commitment. Now, we do not have predictive powers. Our crystal ball doesn't work. But we believe that equity investors could have a better potential to meet their goals over long periods of time. Historically, investors with long-term plan that stayed the course and remained invested have been rewarded. The coming months should be filled with uncertainty. A few tips to help you through these uncertain times are: keep your head down, keep your eyes away from the media. Media will be filled with speculation and fear-mongering rather than facts and sound advice. Pay down your debt and try not to incur any more during this higher interest rate environment. Continue to add to your savings. Get that reserve built up. Conduct a full review of your financial plan with your financial advisor with us. Although the year has started on a strong note, investors are better served by preparing for potential volatility, and we believe it'll be here for a while. That's why we always abide by our mantra of proceed with caution. Having a proactive approach to your financial goals and a solid investment strategy is part of the holistic offerings that we guide for our clients. Remember, investing is a long-term activity. While we cannot control financial markets, we don't control inflation, we don't control interest rates, we do keep a watchful eye out on them. And we want you to be comfortable knowing that we're staying apprised of any situations that might affect you. Our goal as the steward of your wealth is to help you through uncertain times like these. We always attempt to help you create a well-crafted, customized plan for your unique situation and goals that takes into consideration how you would react to market up and downs, including your time horizon, your tax implications, liquidity needs, your risk tolerance, and your overall personal objectives. Now, if you have any questions about your personal situation, by all means, please call our office. Let us know at your next meeting. Set up a meeting. We'll work with you to help you solve that. A little different take here. Currently, the tax law changes that were part of the Tax Cuts and Jobs Act, passed back in 2017, are set to expire after 2025, next year. This means that many of us will be seeing a possible tax increase in 2026. Now, one of our goals is to offer tax planning strategies when we can to our clients. 2025 will be an interesting year for tax planning, and we're planning to provide more information to help our clients prepare. Now remember, as we stated at the beginning of this presentation, we believe knowledge is power. The more you know about what's going on, the better prepared you're going to be. Now, one critical part of the sunsetting of that Tax Cut and Jobs Act rules that could affect our situations is the sunsetting of the federal estate lifetime tax exemption amounts that, in fact, as laws currently stand, revert to lower inflation-adjusted 2017 amounts. All right? They're also looking to raise the estate tax rate from 40 to 45%. Now, currently, federal estate laws seem very generous. However, when the 2017 Tax Cuts and Jobs Act, TCJA, rules were set up, they were set to expire at the end of 2025. That may or may not be the case. We believe in proactive tax planning, and waiting until the tail end of these time-constrained rules might cost you. We like to think ahead, look ahead for changes, especially when it comes to potentially major tax liabilities. So for some of you with larger total estates, if you'd like to discuss this, if and how you can help protect yourself or how you might be affected by the currently sunsetting tax rules, please call our office to schedule some time to go over your unique situation. For planning purposes, the IRS has released their 2024 federal income tax brackets, so you can be aware of the tax brackets you'll fall into for this year. But with the Tax Cuts and Jobs Act rules sunset in 2026, the income tax rates are also expected to increase, and you'll likely get into a higher tax bracket and get there more quickly. Now, this is a good time to look for tax planning opportunities in case that affects your situation. Although today we're discussing the economy and equity markets, later this year we'll once again be proactively exploring and sharing some in-year tax planning strategies. So make sure you're signed up for our next webinar. On a final note, I want to leave you with a quote by the late great Charlie Munger. Go to bed smarter than when you woke up. I love that saying. I hope this workshop has been informative and helpful for you. Of course, we have some disclosures that we want to make sure you have a chance to read. If you need to, please pause this recording so you can see that. If you want to contact us, if you want to get in touch with us, here's a way to do that. Please reach out to us. Thank you for listening to this and getting yourself educated. If you have any questions, please reach out to us. Have a wonderful rest of the year.